The things you're told are good investments by companies, the bank, and your peers are actually draining your bank account. These assets might seem like good investments at first look, but they're actually making you poorer in the long run. So let's look at the 7 worst assets that people believe they need to strive for, but will actually have you constantly chasing your next paycheck. Number 1, new cars. According to Auto Trader, 18 to 29-year-olds are more likely to prioritize buying a brand new car over buying their first house because they see it as a bigger life goal. But buying a brand new car is one of the worst financial decisions that you could make because they lose value all the time. According to the AA, a brand new car will have lost 60% of its value over the first 3 years, which means that it starts to lose value as soon as that car is driven out of the showroom. Wealthy people are far less likely to buy a brand new car because they know how much of a bad financial decision that really is. And once you've worked for so long to build up your wealth, you're far less likely to put that money into something that will lose 20% of its value each year. But to make things even worse, most people are buying those cars not with cash, but with high interest debt. Most people will use debt or loans to buy the things or the so-called assets that they want today. But by doing that, you're paying interest on those things, which means that they are even more expensive and makes them a complete waste of money. Car dealerships in particular will focus on the monthly payment that you need to make rather than focusing on the interest rate or the total payment over the lease term that you're tying yourself into. And it's not that wealthy people don't use debt, because they very much do, but they use debt as a tool to make even more money. And what most people don't know is that debt can be used to grow your wealth. So what the wealthy will do is they will borrow against their existing asset into further assets like real estate or shares in businesses, which will generate passive income or will appreciate in value over time and will make those people even richer. They're not likely to use loans to pay for things that don't make a return, like holidays or brand new cars. Status symbols. Nobody buys a Chanel handbag or Hermes Oran sandals for the craftsmanship, because you can buy items of similar quality for a fraction of the price from lesser known brands. These overtly branded items are more about signaling to people that you have money, or at least that you can spend thousands of pounds on a handbag. And these brands know that now, and that's why they target that aspirational middle class. But if you're not careful, the need to have that latest status symbol could take you away from actually growing your wealth by investing for your future. Wealthy people do buy luxury items too. I'm not saying that they don't, but usually they have already made their money, they're not in debt, and they are investing for their future. And they choose to buy luxury because they can, and it's not necessarily about having overly branded items. Investing can be a powerful tool for potentially growing your wealth, and that's why I want to introduce eToro, who are kindly sponsoring today's video. eToro is one of the world's leading social trading and investing networks, allowing anyone to invest in everything from individual stocks and ETFs to over 40 leading cryptocurrencies with unmatched simplicity and a minimum deposit of just $50. You can follow and research assets with some easy to use features like different charts for beginners and advanced users and research from top investors and analysts. You can even choose to replicate the investment moves of eToro's top investors. The trades are automatic and you can benefit from other investors' knowledge and experience. eToro also offers tools to help investors make smarter decisions, like the 100k virtual eToro account, which lets you open a free virtual account credited with $100,000 so that you can try investing with eToro risk-free. To get started, just click on the link in the description. Cash savings. It's important to have cash savings, but usually 3 to 6 months of living expenses is considered to be enough of an emergency fund. But it's tempting to have more than that, because having cash feels like a comfort blanket and it makes you feel safe in case any unexpected expenses come up. But the problem there is that your cash is losing value all the time thanks to inflation, which means that everything in the real world is getting more expensive, but your cash cash isn't earning enough interest to keep up with that. So that means your wealth is growing in relative terms because you have more cash than you did before you started saving, but your wealth isn't growing in real terms because everything in the real world is becoming more expensive. But it's not just inflation, it's also the opportunity cost of having so much cash that you're not making the most of investing in the stock market. The average stock market return over the last century, adjusted for inflation, has been around 7%, and interest rates on cash savings accounts don't achieve that much. Big homes. Most people see their home as an asset and they think it's a good investment, which is probably underpinned by a common belief that property prices double in value every 10 years. The value of your home might go up, or it might go down, or it might stay the same. But what your home will definitely do is take money out of your pocket every month in the form of mortgage payments, utility payments, renovation costs, and repair costs whenever anything breaks. And the bigger your home, the higher those costs will be, and the more expensive your running costs will be each month. Most people want to buy the best house they can for their budget, and they will stretch themselves to get a nice home because it's where they're spending so much of their time. And that's completely fine. And if it's important to you, then you should go ahead and spend money on it. But just make sure that your house isn't taking up all of your monthly take-home income. Lottery tickets. You're far more likely to be struck by lightning than you are to win the lottery, according to statistics. But even so, £8 billion was spent on lottery tickets in the UK in the year to April 2024. Poorer households are far more likely to play the lottery than wealthier households, according to a report by The Economist. That makes sense because playing the lottery gives people a sense of hope when they most need it. Maybe they're struggling to buy a house or to pay off their debts. People with lower incomes make up a disproportionate share of lottery players, and in that way, critics say that lottery games are very much a tax on poorer households. Tech upgrades. Tech upgrades might promise a faster user experience or a more professional camera, but for smartphones at least, those upgrades are minor and they're usually not noticeable. Some people like to have nice things and they might justify having the latest upgrade by saying that they use their phone for absolutely everything. But whilst the cost of the latest iPhone might be £1,000, the true cost to your wealth is much higher. By buying the latest upgrade and not investing that money, you're giving up the opportunity for your returns to compound over time. So if your phone works, then try to resist that temptation to upgrade and keep your phone for as long as possible. So those are the 7 worst assets that you could choose to spend your money on. Let me know in the comments if you agree or if you think I've missed any. Don't forget to subscribe if you haven't already, and I will see you next time.